Good afternoon, everyone. Thank you for joining us today. My name is Maria Asher, and I'm part of the investments team that manages the Westwood Select strategy. Today, we wanted to take this opportunity to discuss about what's happening in the market, what to expect with Biden presidency, and other hot topics that are on top of our clients' minds. For that, we have Leah Bennett and Adrian Helford joining us on the call as well. Leah is the president of Westwood Wealth Management Houston and is the lead PM on Select Strategy. Adrian is a senior vice president and the director of multi-asset portfolios. He's also an expert on macroeconomics. Hi, Leah and Adrian. How are you doing?
Very well, thank you.
Doing well.
So, I have prepared some questions for you, and it's for both of you, so feel free to share your thoughts and insights. So, my first question is about the markets. What happened in March last year, I'm sure we all remember, but since then, the S&P 500 has returned more than 70%. Why do you think the markets have been so resilient, and what are the factors that are driving this strength in the market?
Well, thanks, and thanks everyone for listening. It certainly has been resilient. And I often, when I think about an economic framework, I go back to looking at a virtuous and vicious cycle. Consumer spending leads to capital expenditure, which leads to more jobs, which leads to higher wages, which leads to good consumer confidence, which leads to consumer spending. Of course, we took a big hit in consumer confidence and consumer spending, which was where we see the intertwining factors and that smooth upward trajectory almost that we've seen since the March low. I think you have to think about that cycle, and you almost have to look at markets in stages of recovery from this one. The first stage was just pure stimulus. We saw a consumer viral earthquake that opened a big old void in spending. We filled that void with public stimulus. And then you think from March 23rd, which was when things started recovering, because we acted really fast as a fiscally stimulative nation, as well as on the central banking side. That went on until about the end of April. The next was just signaling, and that's the central bank and the fiscal authorities, the US Treasury, saying, don't worry, the punch bowl is going to stay at the party. Not only is it going to stay there, but we're going to keep adding tequila as much as needed. It's going to stay. That signaling that they gave us said that they're going to draw a line under the wealth effect, under risk assets. That's helped significantly through central bank speakers and politicians. We did see some drops then in September and October as concerns around politics and uncertainty started to come into play. The market wants less noise. They don't like unpredictability. So as we've come through that now, we see simply predictability, lower policy uncertainty, an ability as a CFO to plan for how you might spend, whether you're going to, as I say, on capital expenditure, then buy new machines to make more widgets. Now we're looking at, if you screen out all the noise of this election, because election for markets it's kind of noise, and you're trying to listen for that baseline effect of what it really means. The consistent hum is now federal spending and trying to achieve an increase in corporate confidence. Corporations are messaging through earnings that we follow significantly that the lower uncertainty, higher outlook, simply the ability to put their dollars at work on growth where they're not going to get shellacked by new regulation is leading to capital expenditure, and jobs are telling the story by coming back strongly. That's more positive. So in short, a resilient market to me, it comes from the several paths. It can continue if these portions of the cycle remain intact or are bolstered by fiscal authorities and central bankers. Low interest policy is going to be the biggest driver of that and the biggest problem if they pull that punch bowl back.
And Adrian, I think everybody has a little bit of COVID fatigue. I like the analogy of the tequila party. I think that might resonate with some folks. I also think I agree with Adrian's comments, and you have to think about the composition of the indices as well. So coming into this period, so if you look at last year, despite what happened, the Russell 3000 actually returned just under 21%, which is astounding. But if you look at the unweighted return of the market, so if you were to equal weight every stock that is in the Russell 3000, the return was only 12.5%. And it's really interesting because we went into a situation where where the larger cap companies benefited from the at-home environment. So you've obviously had Apple, Amazon, Microsoft, Netflix. Those guys did really well during this at-home environment. And then the market really shifted when we had news about the vaccine. And now you're starting to see kind of your small and mid-cap companies, that the companies that are ultimately going to be the survivors coming out of this period are the ones that are outperforming now. And I think part of the reason the market is so resilient, in addition to the factors that Adrian mentioned, are number one, we probably underestimated, the market's probably underestimated the amount of operating efficiency that has been generated through this period. So companies have been forced, especially small mid-cap companies, have forced to become more innovative. They've had to strip out their costs in order to survive, and they will benefit certainly from their peers who have gone out of business during this period. So I think we're likely going to see a period where we're seeing a nice acceleration in operating earnings from those efficiencies. And we've already seen it from some restaurant companies that have pre-released earnings. And then I think the other big factor going on in the market is bond yields are exceptionally low. So we've now gotten back to a situation where the 10-year is yielding 1%, which is a big move up in rates. And it's hard to believe a big move up in rates results in 1%. But we're back to where we were of March of last year. And I think that has forced more money and will continue to force more money into the equity markets as well.
Thank you so much. That's very interesting. So let's talk about the Biden administration. And now that Democrats have a control of the House and Senate, how do you think a Biden administration can impact the markets? And thinking more about personal financial planning, what factors do you think one should consider in regards to that?
Sure, I'll start and say we now see a little bit more further, and we're going to see more, but we've got a good idea of the new administration's economic agenda, including both near-term stimulus that they're looking at and what's going to be a second bill likely this year comprised of sort of watered-down long-term agenda. Overall, these measures are likely to boost the deficit by around 5% of GDP in 2021, another 2% in 2022, and then if we continue the path that they've prescribed to reduce long-run deficits by about 0.5% of GDP annually further out the curve. This kind of assumes Congress is going to end up passing 1.2 trillion. Of course, you know that it's the 1.9 trillion is proposed right now. For spending, we're going to see a large amount of outflows. We expect about 700 billion of new net outlays for infrastructure. That's a combination of, with this administration, traditional infrastructure, green infrastructure, non-traditional. We'll see subsidies for production of electric vehicles, subsidies for R&D, especially on the climate change front. All that will make its way into the economy. So then the big question is, well, how does that impact markets? In several areas. Interest rates and inflation, like Leah mentioned, we've already seen some preface of that. Markets are expecting things like longer maturity interest rates that are already rising and will probably continue rising this year. Inflation expectations, and expectations, I key in on that word, are likely to continue rising this year further. The realized inflation, it does remain to be seen. The markets can look further out than the realized numbers. We'll see some impact to sector leadership from these changes. This is continued equity markets rising at a headline level, but maybe with financials benefiting, industrial materials sectors can benefit from this, just as I talked about infrastructure investment. Technology, which is, of course, very topical given how well it's done, can continue to hold some of its ground given holding the short interest rate a little lower. So that'll be a possibility. Taxes, that'll be a question mark. I don't expect much. I'll keep an eye out, but I don't expect much until the August congressional recess. I think they've got initial priorities, which are fiscal spending. They will try and get through reconciliation. And then next we'll start to hear about corporate tax rate and some of their priorities on that front further. Fiscal spending, that'll be a big deal. And then finally, trade policy. This is China negotiations and sort of defensive stance will continue. but they're likely to change in character, less tariffs, more diplomacy. And that is a positive that should help offset some of the tax negatives.
Yeah, and I think from a personal perspective, what people should really be thinking about, I think a lot of people have been anticipating, obviously, the changes. We will have higher income taxes at some point. And Adrian's right, is that I think there is a fear, or was a fear, that it could be done retroactively to January of this year, or it can be. Or that the estate tax exemptions are going to get changed retroactive to the beginning of this year. And I think that's unlikely, but it is something that people have to plan for. So it's worth talking about for the estate exemptions. Planning right now, you have the ability to pass 11.5 million per person, which is indexed for inflation. So it's a little bit higher than that, but roughly 11.5 million per person on to other your spouse or the rest of your family, and anything above that gets taxed at 40%. So, for example, if your estate is worth 12.5 million, and you're single and your exemption is 11.5, then that $1 million is taxed at 40%. What is likely going to happen is the exemptions are probably going to get reduced, and that'll be a part of the way that we can tackle the deficit, which we're going to talk about later on. But if you reduce those exemptions down to 5 million or even 3 million, there's an opportunity to do lots of planning right now. And planning involves gifts either to your kids or grandkids or to charities. And I think that's going to be a big theme that we see this year. And we're kind of helping clients talk through some positives and negatives around different types of entities that they can create. And then higher income taxes is definitely something that I think people need to prepare for, and really thinking about tax efficiency within investing. And again, thinking about where it's more tax efficient to create maybe an LLC or to create different entities depending on what clients' needs are.
Thank you so much. Super helpful. So let's talk about the technology sector. As Leah, you mentioned that some of the technology companies were the biggest beneficiaries of people staying at and working from home. So I would love to hear your thoughts and your outlook on the technology sector, especially in regards to, the recent political events, the debate around their influence and the freedom of speech.
Yeah, it's so the technology sector I think is really interesting. It's obviously done exceptionally well, especially as we have made a massive change to the economy and gone to this work at home environment. Tech has also grown enormously over the last few years, and has a considerable amount of power. And certainly, freedom of speech issues are starting to come up. The size of them has really been illustrated by events that have occurred this year. The big issue that I would really challenge, so tech has outperformed for quite some time. It's 28% of the Russell 3000 now, which is a very large percentage of the index. They basically pulled forward many years worth of spending into 2020 because of the work at home environment. I think they'll continue to play a very large role in our lives, and that will continue to be the case. But from a valuation perspective, they're quite expensive now. And I think concerns, especially with the Biden administration and having different control in Congress, I think antitrust issues are rising as it relates to the sector.
Yeah, I would say that a lot of that is very telling as well. You see how much it's come up. I kind of look at it as there's a little bit of three techs that we've seen. We've seen big tech, so the so-called FANGs that have done extraordinarily well. Green tech is the second one, and kind of most other things. Let's think about those for a second. If you split it out like that, big tech has been supported certainly by economies of scale, adoption of new technologies as an outcome of the COVID crisis. Think Microsoft Teams, think Amazon delivery and all the Apple devices, and us sitting on our couch watching Netflix. That's done extraordinarily well. Green tech has presaged, I think, some of the stimulus and the pointed direction of that we now see, and has done extraordinarily well as well. That's alternative power systems, plug-in technology, solar tech. That can potentially continue depending on the size and the negotiations around that. That's, clean energy and tech ETFs up 230% on a year, 22% this year already. Then you start to look at the remainder, and really one of the key factor for a lot of these, which is when you think tech, you often think much higher multiples. You think the fact that the NASDAQ is trading at about a 35 times multiple versus the S&P around 23, meaning they're looking for further realized cash flows and earnings, not realized today, but in 10 years' time. And of course, those cash flows become more valuable when interest rates are lower. I discount them at a lower rate. So super simplistically, this is saying everyone knows you'd pay only $80 for $100 back 10 years from now. Well, with zero interest rates and low inflation, you might be happy to pay $95 to receive $100 10 years in the future if it's sitting idle, because it just doesn't depreciate that much. Those long end cash flows from many of these tech companies, the traditional tech, have been advanced in valuation because of that, not because some of their revenue streams are going to be so awesome, simply because the value of their cash flows have increased. Questions on influence and the freedom of speech. I talked about political noise. I think the engine of capitalism quickly barrels over much of valuation impacts. Thus, the wealth effect on people, if they push further down that, will start to push on politicians. Thus, it's a bit of a sum zero net balance game. I'm reluctant to take a view on it so far.
Thank you so much. Super helpful. So the next question is something that is on the top of our clients' minds, and it is the US dollar. So as Adrian, you mentioned the massive stimulus that was passed last year, and then more is expected this year. What is your outlook for the US dollar? And I think just to build on it, we have recently seen, actually all of 2020, we saw a surge in prices in gold and silver, and more recently in Bitcoin. So I would also love to hear your thoughts on Bitcoin and if it's a bubble.
Sure. Bitcoin's off 10% today, so it'll be a good day to talk about it. On the US dollar, it's never just the US dollar, of course. It is the US dollar versus the euro versus the yen versus the Swiss franc. It's always a relative value dynamic, and that is one element of, we are in somewhat competition. When we try and increase the value or devalue our currency, we do so in competition with other nations around the world. And we may not be doing so outright, but by our monetary policy, we are effectively doing that by keeping our interest rates, our base interest rate, extraordinarily low for a really long time. And Chairman Powell coming and saying that don't expect anything to move anytime soon. That effectively does have a diminutive, a downward effect on the US dollar. I think that dynamic will likely continue, and I don't think we're headed for a currency war, but I think that likely continues. What could change that is if we start to see the European Central Bank become more dovish, or if they experience more of a difficulty whilst we grow our way out of this with the extraordinary stimulus that we have built out. So I don't think that that's a likely dynamic for the year. We're in the boat together, and our monetary policy has been very, very accommodative. That'll drive the value of the US dollar somewhat down, but we're not looking for a crash. On Bitcoin is just really interesting, and it's, I keep thinking of, it's really the blockchain technology. It is then the concern that the more, I think that's part of it, is the more our deficit spending makes our ability to manage our liabilities in the future further and further from reality, because we have such a heavy debt load now, the more there's just the possibility that people will look to Bitcoin as an alternative source of a store of value, similar to gold. And it does have similar characteristics. That's that blockchain technology that has a restrictive amount on the number of Bitcoins you can hold. You can only create so many of these things. Gold you can, of course, dig up out of the ground, but it's historically it's been that store of value for similar reasons. And I think those are good places to own a fair amount of. Bitcoin, I say, very difficult because it's got so much volatility. It's down 10% today, has days where it's up 10, 15%. People are still trying to explore what the actual fair value of something like that is, because it's a store of value. You can't value the cash flows on Bitcoin. But I do think it's in a year where we're going to start to question on very low interest rates, especially in the intermediate maturity spectrum. People will look for an alternative source for, number one, a store of value, and number two, a safe haven that gold might go up when things go down. And that may not always be the case for bonds. When their yields go down and the prices go up, their yields can only go down really so much when the 10-year interest rate is at 1.1%. If we experience another big downturn, gold may be a better place to be, or at least to have some of your assets.
Yeah, and I think Adrian makes a really good point. In particular, I think a lot of times people look at the dollar or the deficit within a vacuum and not in a greater context, and really looking globally at what's going on. So obviously, and I know we're going to talk about the deficit later, but from a debt to GDP perspective, while the deficit is increasing, the dollar should weaken. But I agree, there definitely should not be a collapse there by any means. And if you look at currencies, we always go through cycles. And the US has done a really phenomenal job of, we came out of the financial crisis much faster. It is because we had a lot of stimulus and really got ahead of that problem. We came out of it much quicker than Europe and the rest of the world did. But if you look at this particular crisis, being a health crisis, the US has actually lagged some of the emerging markets. In particular, China has actually rebounded quite nicely out of this. So as we go through cycles, I think it's natural that the dollar is on the kind of the downside of the cycle. The dollar will continue to be somewhat weaker. And then you've got to think about, I don't think it's the dollar's weakening, and so Bitcoin is my only option. Again, kind of looking at, how do I take advantage of a weaker dollar? Where should I be investing? And I always think it's important to look at risk-adjusted returns. The volatility with Bitcoin, the illiquidity, and some of the security issues around there are things that would push me away. And what I would look at, or what I think is really interesting, is some of the emerging markets. And the emerging markets have obviously, for some of the reasons I mentioned, have lagged the US for a while. I think they look increasingly attractive as some of their economies are doing much better than the US. And as the dollar's weaker, their currency is denominated in US dollars. And of course, their revenues are denominated in their local currency. So again, kind of going back to that same analogy of what's happening with companies in the US, where you're getting better operating margins, you're kind of getting that spread is helping some of those emerging markets. So I think those are interesting areas.
Super helpful. That was very interesting. So let's talk about the deficit, as you guys talked about. How do you think, especially, with more stimulus coming up, how do you think the US can address this growing deficit, and what are the long-term ramifications around it?
It's going to be tough. I think we're getting to the zone where it's hard to see how we're going to repay our debts through traditional means, which means either increasing revenue or lower spending. Increasing revenue comes from, as you know, higher taxes. That's at a time when the economy still sits on a bit of a precipice, or exorbitant growth, which is hard to see with higher taxes. And I believe the deficit itself reduces the possibility of that higher growth happening. Lower spending, in the near term, that's unlikely. We know that from the current administration and proposals. In the intermediate to longer term, it's hard to find that much cuts. There's a possibility, and the plan as proposed so far looks for the near-term deficit to start decreasing, relying on the role of later-term taxes kicking in without the spending increases. Longer-term ramifications, the concerning one certainly would be what's often been talked about, the Japanification of the economy. If we hold fast to traditional methods of repayment like that, that could reduce long-term growth, and so you could see a lower growth profile going forward. and increase deficit spending, which that would mean the possibility of more of the modern monetary theory, kind of finding a way to print our money to pay our debt. Now, hopefully, we find a better way to do this than Zimbabwe, to keep the confidence in what we've been talking about, which is our very valuable global reserve currency status. It's still far off, though, and I'm not a naysayer. I think there are many tools in the monetary policy and fiscal toolbox that we'll try and use before we change too much on that front. But the ramifications are slower growth, I think, until we figure that out.
Yeah, I agree with Adrian. It is a challenge. I continue to be curious about what the long-term ramifications of this crisis are. I do think we've had a lot of demand destruction, and I'm curious to see how long that persists. And there's I know a lot of the concern has been around inflation, but there's lots of deflationary factors at play. One being technology itself. Technology by nature is a deflationary factor. So it's going to be interesting to see how, if we do have demand destruction and have a slower growth coming out of this, and run into a period of where we're having to increase taxes, that's going to be a challenge. But I do think that is not near term. I think that's probably something medium term that we'll run into over the next couple of years. The positive that I see that could emerge as something that's helpful is kind of two factors. One is I do think usually when we've come out of periods of distress, we have also emerged with a period of really high innovation. So I'm kind of curious to see what level of innovation comes through this period. And I've talked about this on previous calls, but if you look at if you look at 2008, for example, the crisis that we went through, kind of the unintended consequences and the innovation that came out of that was you had a whole generation of people who were scarred and didn't want to own things because of the housing crisis, and that generation basically is what became the catalyst for Airbnb and Uber, and they created an area of the market that didn't exist prior to, or either didn't exist or didn't have a big presence prior to 2007. And I'm kind of curious to see if we have something like that over the next couple of years that starts emerging. That's a trend I'm watching. And then the other thing that I think that could possibly be a positive as far as the economy is concerned is as the US has become a more service-driven industry, our workforce has become more portable. We have more portable skill sets. When we were so manufacturing based, which had a positive for many other reasons, but those skill sets weren't as portable to other industries. I've definitely seen just personally as the oil and gas industry has gone through changes here in Houston, we've seen people be able to move to other industries that are growing more rapidly because those skills are much more portable than they were 10 years ago. So I'm kind of curious if that helps unemployment come back a little bit faster. But I do agree, overall, it's a challenge. But those are kind of the two trends I'm watching that could help us get the economy up and running, which would certainly help with the deficit.
Thank you so much. That was definitely very interesting to hear. So let's dig deeper into the interest rates. I know we discussed it briefly. Adrian, you mentioned, and last year, Fed chairman basically said that Fed funds rate will remain around 0% in the near term. So I wanted to get your outlook on the interest rates, both near and long term.
Sure. And I'll be quick because I know you've got all things to do for the day. The near-term things, the interest rate is going to remain anchored. As I said, Chairman Powell and his colleagues have given us that message that when they, on a quarterly basis, show their so-called dots saying where they expect the interest rate to be, they're not looking for a rise in the interest rate. They've already given the message that they will, in not so many words, let the economy run hot vis-a-vis inflation. So when they tie to the dual mandate of inflation and labor, they're not going to worry about an overshoot of inflation. They're going to let the average come above 2% as opposed to the target of 2%, which means interest rates will remain lower for longer. In the longer term, and when I think longer term, this is 10 years plus, this should start to lead to a rise in interest rates. And the longer term, the 10-year plus, is more of a proxy for nominal economic growth. And we could see that rise long before the Federal Reserve takes its foot off the gas pedal. And every time we see that happen after a recession, where the difference between the 10-year yield and the 2-year government yield goes up to 3%. Well, right now we are right around 1%. So we could see the 10-year yield rise another 1.5% to 2% here. I don't know about this year, but over the longer term, as we see stimulative policy, and if it actually does take place before they, I'll go back to the old, before they stop pouring that tequila in the punch bowl, and that'll impact sector leadership and other areas and everything we've talked about today.
Thank you so much, Adrian. These are all the questions I had today. Thank you so much, Leah and Adrian, for your insights. With that, I'll bring an end to our call. Thank you, everybody, once again for joining us. Please feel free to reach out to your advisor if you have any questions, and we hope you have a wonderful rest of the day. Bye-bye.
Thank you.
Thank you.